fixed rate mortgages, trackers, discounts, offsets, flexible, lifetime, standard variable rates, the list goes on. On this video, we're going to look at each mortgage product individually and how to simplify the process. Coming up. Hey, how's it going? My name's Alex Kerr. I'm a qualified mortgage broker, and on this channel we bring the best mortgage tips to first-time buyers and business owners. Let's jump into the video. Hey guys, right, so let's have a look at mortgage products. Just want to say, if you're new to this channel and this is the first time we're meeting, please consider subscribing. I'll hook up all the mortgage products in the show notes. Please refer to them at any time. So let's start with a fixed rate mortgage. A fixed rate mortgage, looking at the word fixed, means it's going to stay the same, and that's in terms of your rate and your monthly payment. So if you choose a fixed rate mortgage, you know that your monthly payment is going to stay exactly the same. Now, however, you do have another choice to make. Generally speaking, with fixed rate mortgages, the longer you fix the term for, the higher the rate is. You can have a 2-year fixed rate, a 3-year, a 5-year, sometimes a 10-year fixed rate mortgages. They did previously do them for a little bit longer, sometimes the length of the mortgage. However, on today's market, you're typically seeing 2, 3 and 5 years and then an occasional 10. Okay, now my advice to you, if you're maybe a first-time buyer and you want to minimize costs for the first few years, then maybe think about a 2-year fixed rate. That's because it's going to keep your monthly payments low. You're going to get a feel for how a mortgage works and everything like that. And then in a couple of years, you can obviously then remortgage and think about your product again. Okay. Generally speaking, if you're looking at a 3 or maybe a 5-year, and you want that extra security, your monthly payments aren't going to change. Maybe you're going to stay at this property for a little while, you're a bit more experienced, then maybe a 3 or a 5-year may be suitable to you. There are pros and cons of whether you choose a 2, 3 or 5-year fixed rate. Generally speaking, a 2-year is meant for keeping your costs down and low in the early years, and the rates will generally be lower at 2 and 3 years. However, if rates increase during your 2-year fixed rate period, that means when it expires and you need to renew it, a term called remortgaging, then your rate could be higher. You could have benefited from maybe a 5-year fixed in hindsight. Very difficult to tell, but generally speaking, 2-year for your lower monthly payments, 5-year if you're a bit more settled, you know what you're doing for the next 5 years. Obviously, the disadvantage of a 5-year is if you went for a 5-year and then during that whole period of 5 years rates stayed the same, you could have done 2 or 3 2-year fixed rates and ended up saving some money. But generally speaking, fixed rates, they're good, they're solid, and they're for people with a low risk outlook. Don't want to take much risk. You know exactly what you're paying each month for a certain amount of time. Trackers. Okay, so as the name suggests, it does generally track the Bank of England. Okay, now the Bank of England sets a base rate. They meet once a month and decide what the rate is going to be. At the moment, the rate at the point of making this video, it's 0.75%. So let's imagine that your tracker product was 1% plus the Bank of England base rate. What that would mean is your starting rate of the tracker would be 1.75% because it's 1% plus the Bank of England base rate, which is currently 0.75. Now, advantages of trackers, I would say sometimes you can get them with no tie-ins. Okay, so that means if you redeemed or repaid the mortgage off in full at any period, you would not have any penalties. So for example, let's say you buy a home, okay, and over the next couple of years, maybe it's a little bit run down, you want to renovate the property and then sell it on. Let's say that period was 6 to 12 months. It's unlikely you're going to get another fixed rate or another product for 6 to 12 months. Sometimes a no tie-ins tracker will benefit you. You can, the risk is relatively low because if rates went up, in 6 months or so, you'll be paying it off and buying another property. Okay, disadvantages of a tracker, the rates can go up and down. Okay, so if the Bank of England base rate goes up, so does your rate. Now, generally speaking, the Bank of England rates normally, historically, go up or down by 0.25% margins, but that's not guaranteed, okay? So that is the element of risk. Your rate can increase on a monthly basis potentially. Discounted rates, okay? Similar to a tracker, all right, but not quite the same. It gives you a discount off the lender's standard variable rate of interest. Now, every single lender, mortgage lender, will have a standard variable rate. What that means is when your mortgage product expires, so let's assume you had a 2-year fixed rate or a 2-year tracker or a 2-year discount, when that period expires, a little bit like car insurance, house insurance, it expires. If you don't do anything, okay, the rate increases. You are stuck on the lender's standard variable rate of interest, okay? Every lender has one. Now, a discounted mortgage will give you a discount on the lender's standard variable rate of interest. So, for example, if the lender's standard variable rate was 5% and they gave you a 3% discount, that means you would have a 2% rate. Now, let's imagine that your discounted rate was a 2-year or a 3-year. After that 2 or 3 year, again, you'd revert to the standard variable rate of interest. What are the pros and cons of a discounted rate? A discounted rate, unlike a tracker, can start even lower. Okay, so you can sometimes get very low discounted rates. However, the disadvantage is, again, like a tracker, it can increase in rates. And generally speaking, the standard variable rate is dictated by the mortgage lender and not the Bank of England. Okay, so the mortgage lender, I would say there is more likelihood that they could put your rate up or their standard variable rate up at bigger increments in comparison to the Bank of England base rate. Okay, so just bear that in mind. You generally have a higher risk outlook if you're going for products which can go up and down in rate. So my recommendation is that you definitely have quite a good buffer of affordability on your monthly disposal income each month. Offset mortgages, okay, used to be very, very popular, not quite as popular now because other products have been more innovative. However, generally how they work, let's assume you've got £50,000 in your bank account as savings. An offset mortgage would be offsetting that £50,000 against the interest you pay on your mortgage. So if your mortgage was £100,000 and you had £50,000 in the bank, that means you would only pay the interest on £50,000 of your mortgage. So it gives you added flexibility. It's a little bit like only having a £50,000 mortgage, but you've also got instant access to your £50,000 if you wanted to lay your hands on it, rather than it being tied up within the equity of your property. So that is the real flexibility and attraction of an offset mortgage. Now, generally speaking, they are quite flexible. You can make overpayments. Now, let's say your savings balance in your offset account was £50,000. Let's say you spent £5,000. Okay, that means obviously you would now have to pay interest on the remainder of your mortgage. It would be £5,000 more, okay, because you've just spent that from your savings offset. Also works the other way. If you deposited 10,000, that means your interest levels would come down, your monthly payment would come down. Now, lenders will give you the option when you overpay of either having it reduce your monthly payment, okay, or having what's known as a lump sum payment. So it just reduces your mortgage balance, but then you don't have the flexibility of having that accessible in your offset account. Flexible mortgages. So as the name suggests, they're very flexible, funny enough, because they're very easy to go in and out of the mortgage. You can pay it off, generally speaking. It will have no tie-ins. You can overpay, you can underpay. There's no real restrictions with a flexible mortgage. Okay, pros and cons. Okay, pros, you can overpay, you can pay the whole amount off generally with no tie-ins. Okay, disadvantages, it's not fixed, you know, the rate could increase or decrease, you know, dependent on the lender's variable rate, or if it's linked to the Bank of England rate, you know, your monthly payments are at risk of increasing. That's the disadvantage. Okay, generally speaking, you know, if you've got a good amount of savings and a good amount of monthly disposable income, a flexible mortgage could be for you. Stepped mortgages. Now, I don't like stepped mortgages myself personally. For example, you could get a stepped mortgage which starts off at 0%. Okay, so let's say you had a stepped product or a stepped mortgage for 2 years, and in year 1 the mortgage was 0%, and then in year 2 the mortgage goes to 3%. Okay, so the reason I don't like them, okay, great, you know, they're fantastic in the early part of the product and the mortgage, but suddenly you've got this big jump and you're going to get used to really not paying the mortgage, or paying a very low interest rate for the first year or so, and then you're going to have this jump. So that's why I don't really like them. I much prefer a different product where you're paying, you know, the same amount from the word go. So that's generally the mortgage products that are available with every mortgage lender. You may see some different abbreviations, some different terms used, but generally speaking, they all come under that banner. You know, some lenders will use different words, different names, things like that to explain these products. Generally speaking, a fixed rate, you know exactly where you are, you know what monthly payment you're paying. The rest of them are normally variable rates, so they can go up and down. Generally speaking, your choice of product should be linked to your outlook on risk. Okay, so if you've got a low risk, you don't want to take very many risks, go for a fixed rate product. You know where you are. Maybe if you're a bit more of a gambling man and you're a bit more experienced and you tend to jump from property to property, or you know, you like renovating the property, things like that, then maybe the discounts or the trackers are a little bit, you know, for you. Maybe a flexible mortgage with no tie-ins, you know that you're going to renovate the property and move on to the next one. You know, you've got good maybe cash reserves and things like that, so if your monthly payments and the rates did increase, you know, it's not going to cause you a problem. Question of the day: are you unsure of which mortgage product to choose? Let me know in the comments. I'll steer you in the right direction. As a responsible mortgage broker, we are obliged to tell you that your home may be repossessed if you do not keep up repayments of your mortgage. So thank you very much for watching this video today. I hope you or your colleagues found this of some value, and please do link with me across all the social media platforms. I'm Alex Kerr Mortgage on LinkedIn, on Instagram, on Facebook, and obviously on YouTube. So please do connect with me. Hey guys, so first time buyers, please do check out my video there. I do provide my top 10 tips when looking for your first home, or if you press there, okay, you can get my next video. Until next time, Mortgage Chain are bringing the best mortgage tips to first time buyers and business owners. Until next time, keep smashing it, and we will see you soon.